$13 billion in sales with a profit of $584 million. That's what Enron made in 1996. The following year, their sales went up to $20 billion, and they made a net income of $105 million. In the next year, 1998, their sales reached $31 billion, and the profit was $703 million. By the year 2000, their sales skyrocketed to $100 billion, and they earned a profit of a whopping $979 million. The stock price soared from $20 to more than $90 on Wall Street, almost a 400% return. The famous Fortune magazine called it America's most innovative company for back-to-back 6 years from 1996 to 2001. Anybody would think that the guys who were running such a successful company were freaking genius. But then came 2001. When they showed a loss of $618 million all of a sudden. The share price went from $90 to just 26 cents. That's almost zero. People freaked out, as a lot of investors had their money invested in Enron. The nation's economy was hugely shaken up because Enron used to be Wall Street's darling, attracting even non-investors to buy its shares. So what went wrong with Enron that turned its epic saga into a nightmare? Why did such a successful company fall overnight, showing a sudden 180-degree turn in its balance sheet? Turns out that the Enron bosses were indeed smart or genius in fraudulent activities instead of business acumen. This is a surprising story of how some extremely skilled men exploited the loopholes of the system and committed one of the biggest and most thought-provoking financial frauds in history. It all started in 1985. When Houston Natural Gas's CEO Kenneth Lay merged his company with Internorth to create Enron, initially focusing on natural gas sales. With ambitions to do something big in the energy sector, Enron expanded into power and energy trading. As Lay was a financial analyst at the Pentagon before, he had many influential connections, including a close relationship with George W. Bush, who played a key role in Enron's political favoritism. We'll come to that later. In the initial years, Lay felt that something was going wrong in the new company. Turns out that two Enron executives, Louis Borgett, the president of Enron Oil Trading, and Tom Mastoreni, the treasurer, engaged in fraudulent activities, moving money to fake accounts with inappropriate names like Ass or My Ass, impacting company profits. Despite their actions, Lay didn't fire them as long as they were making money. 2 years later, they were found guilty of fraud in 1987, involving hidden accounts and millions of dollars. Do you remember the infamous Valhalla scandal in 1987? This is it. Lay initially claimed ignorance, but later was revealed to have supported their actions, although this scam was nothing compared to the one Enron would do in the future. But the news of the scandal became a big problem for Ken Lay during the unstable market after the 1987 stock market crash. So, in 1989, Enron hired a business consultancy firm, McKinsey & Company, for ideas to grow. And one of their consultants, Jeffrey Skilling, proposed an idea of connecting natural gas to people in different ways, making it like a regular thing that everyone could use. Enron liked the idea and named it the Gas Bank. Surprisingly, it worked out so well that Enron appointed Skilling as CEO in 1991. But only Gas Bank was not enough to grow quickly, so Enron tried different things like internet services, power plants, and trade, but had problems that needed special permission. Jeff Skilling also tricked employees into investing more money in the company's shares, even when the company was losing. For example, Enron lost a lot of money, especially because in 1992, a $3 billion investment in an Indian electricity project at Ratnagiri didn't work out. Even though the company was having money troubles, to maintain its good reputation, the company started hiding its losses, and the bosses lied about making a profit so they could get big bonuses. But hiding losses in a fail-proof way is a very tricky matter. So, in 1992, Skilling and Enron's CFO Andrew Fastow found a way out by changing how the company did its accounting and valued its assets. Instead of looking at past prices, they started predicting future prices to determine the value of their assets. This allowed Enron to report profits when they signed a deal, without being checked for the accuracy of their predictions. Enron suggested this change to the SEC, the regulator of U.S. capital markets, saying they wanted to switch from the old way of accounting, which was the historical cost accounting system, to the new method, MTM or market-to-market accounting. That year, the SEC approved this change, and that's when Enron started its fraudulent activities. But how did such a simple change make all the difference? Because what just sounds like a simple change in the accounting system was almost like having a money printing machine to Enron. It all depends on how skillfully you can use the system's loopholes. For example, historical cost accounting only records the purchase price of assets on financial statements, ignoring changes in market value over time, such as if you buy something for $10 million, it shows up on your financial statement as $10 million. Even after a few years, if the price of the asset or your investment grows from $10 million to $50 million, historical cost accounting would still show it as $10 million. This can create problems in understanding the real value of assets. Another important problem is that in this process, some valuable assets may not be shown on the financial statement. This is where the market-to-market or MTM method comes in. It helps a company to determine the value of its assets based on their current market prices. For example, if a company buys assets for $10 million and its later value increases to $50 million, the MTM method would consider the value as $50 million, just the opposite of the historical cost system. The twist here is that share values are publicly listed in the stock exchange, but actual asset values are often estimated internally, which can result in subjective or fictional values. So this can be a powerful weapon for someone who wants to manipulate. Enron took advantage of it. For example, if something was only worth $50 million, they would say it was worth $100 to $110 million. This made their company look stronger on paper. One big example is in their fiber optics business, they got a big $112 million contract with Blockbuster, a video-on-demand company, for 20 years. They showed the money they'd make in their financial reports even before they started the actual work. Similarly, in 1992, they made a $4 billion deal with Scythe Energy, but before they actually did the work, Enron reported earnings, making it seem like they were doing extremely well financially, which was a lie. So, this was the original whereabouts of Enron, which was happening around the time of the dot-com bubble. At that time, lots of internet companies got a lot of money from investors, whether they were doing well or not. The share market was booming. People were mainly interested in making money fast and didn't pay much attention to the details of companies. So, Skilling and Fasto had another plan to get money and used a tricky method called Special Purpose Vehicles, or SPVs. Now, what is that exactly? When a company wants to do any risky business, it uses SPVs with the help of technology to reduce the risk factors. Imagine a company called X wants to start a business in the renewable energy sector, which, by nature, is quite risky. This could harm both X's finances and reputation. So, X creates an SPV to run the new business. If the new business fails or goes bankrupt, it will hurt the SPV only, but X as an entity will be intact. Enron exploited the SPV technique. To solve their money problem, they made an SPV called White Wing Associates LP, and they moved their assets to White Wing's balance sheet. Enron showed banks that they sold assets to White Wing without revealing the original truth, that they actually transferred the assets to White Wing, not sold them. But this lie made it look like Enron was making a lot of money from the sales. Then, White Wing borrowed money from banks like JP Morgan, Citigroup, Morgan Stanley, and the Canadian Imperial Bank of Commerce. This loan was later sent to Enron, which means when the money went into White Wing, it was later transferred to Enron's funds. As a result, Enron's balance sheet showed no loans but had a large amount of revenue, which is a double plus point for a company. Investors and lenders didn't know any of these. Because of this manipulation, the numbers on the financial statements kept increasing, reaching over $20 billion and eventually going beyond $90 billion. Andrew Fastow also hid the company's debts by making fake entities like LJM in 1999, with help from big banks. LJM was a fake company with the name of Fastow's family members, his wife Leah and kids Jeffrey and Matthew. LJM bought Enron's struggling assets, covering up Enron's weak finances. LJM had its own 4 SPVs called Raptor 1 through 4. Enron transferred $1.2 billion in stock and rights to these Raptors, making it seem like Enron was making more money. Later, when the lie was discovered, the company lost $1.2 billion, worrying both the company and its auditor, Arthur Andersen. But Skilling and Lay knew this plan couldn't work forever, so they decided to go to California and merge Enron with Pacific Gas and Electric, which affected the electricity market. Enron traders again scammed the market by selling power out of the state and creating fake outages to make it seem like there was a high demand. California officials stepped in to investigate, but the federal government mysteriously refused to interfere. Well, not mysteriously. This was the time when George W. Bush, a close friend of Kenneth Lay, was the president. But at this point, Skilling was alarmed and he stepped down in 2001, with Lay taking over as CEO just before Enron fell apart. Enron's downfall began with whistleblower Sharon Watkins, vice president of corporate development at Enron, exposing corruption to Lay. The Wall Street Journal pointed fingers at Fasto for being involved in shady deals, which made the SEC look into it. Enron went bankrupt within a month, leading to a big drop in the value of its stocks. The stock price first got frozen at $32, then opened at $9, and rapidly dropped to just 26 cents per share. CEO Skilling sold stocks just before the crash to raise funds, but it failed. Meanwhile, criminal investigations also started. Fasto pleaded guilty, helping authorities, while Arthur Andersen faced a lot of legal trouble. Lay was criminally charged but died before sentencing. The chief strategy officer, Cliff Baker, committed suicide during the investigation. Skilling served 12 years of a 24-year sentence and got banned by the SEC from having a big role in any company. Enron's bankruptcy showed they had assets worth $63.4 billion. A whopping 29,000 people lost their jobs. Stockholders sued banks and won $7.2 billion, which they shared among 1.5 million victims. But do you think this is enough to compensate for people's loss? Is there anything that can stop further scams like this? So what should really be done to stop such companies from stealing public money? Or is it just human nature to find loopholes in anything and exploit it? Let us know your thoughts. Thanks for watching.